In the past 24 hours, every major cryptocurrency including Bitcoin, Ripple, Bitcoin Cash, and Litecoin posted gains of at least 8%. Litecoin went a little overboard and surged more than 30%. At the time of writing, the entire cryptocurrency market at $460 billion with Bitcoin trading at $9,637, which translates into $162 billion market cap. Since yesterday, the price of Bitcoin rose by more than $1,000 overnight. The daily trading volume of Bitcoin across large cryptocurrency exchanges remained solid, and short-term momentum indicators such as moving average convergence divergence, MACD, demonstrate strong short-term momentum for Bitcoin. There is a good chance this rally will continue and soon Bitcoin will once again cross much anticipated $10,000 mark. A major correction at this stage is unlikely, unless a massive sell-off occurs on February 16, during Chinese New Year. Historically, the market has seen some minor corrections during the Chinese New Year. Because it had experienced a major correction earlier in January, it is unlikely that the Chinese New Year will largely affect the market. There are speculations floating around that Litecoin might be in for a hard fork soon. The cryptocurrency recorded a 30% increase in value, overtaking Cardano to become the fifth largest cryptocurrency in the market for the first time since early January. If rumors come true, Litecoin Cash will be rewarded to every Litecoin holder prior to block 1,371,111. While hard fork could be the reason behind the rally, Litecoin creator Charlie Lee noted that the introduction of Coinbase Commerce will allow merchants to adopt Litecoin alongside other major cryptocurrencies like Bitcoin, which could have given more push to the surge. It is important to keep in mind, from here on, a bearish scenario could take the Bitcoin price back to below $7,900. Next resistance level is at $11,000 in case bulls continue the rally. Spain's ruling political party is reportedly drafting legislation that it hopes will help move cryptocurrency and blockchain companies to the country. According to Bloomberg, the People's Party of Spain is eyeing the move as part of a package that would be focused on firms working with new technologies like 3D printers. Yet according to lawmaker Teodoro Garcia Egea, who spoke to the news service, the bill could ultimately include provisions that aim to attract companies that are looking to sell tokens via initial coin offerings. The bill may also specify a threshold below which cryptocurrency investments would not have to be reported for tax purposes. "We hope to get the legislation ready this year," Garcia Egea commented. The People's Party is also encouraging lawmakers to hear testimony from blockchain experts on the matter, and it intends to review regulatory measures that other countries such as Switzerland are developing or have already implemented. Egea told Bloomberg Politics that the technology is good for Spain because it spurs work in other sectors like education, finance and health. The legislation may also be focused in part on encouraging investment in token sales, according to Garcia Egea. "We want to set up Europe's safest framework to invest in ICOs," he was quoted as saying. Spain is far from alone in drafting blockchain-related legislation. Gibraltar, a UK overseas territory, intends to solidify its position on ICOs this month. On Wednesday, the U.S. Commodity Futures Trading Committee's CFTC Technical Advisory Committee, TAC, held a public meeting at its Washington, D.C. headquarters. During the meeting, members of the Bitcoin and crypto-asset industry shared information regarding this emerging market and offered guidance on how the CFTC may approach regulating this space in 2018. Multiple participants in the public hearing made comments to differentiate between different types of crypto-assets and their associated technologies. Potential regulation around crypto-asset exchanges was also discussed as a potential area for further regulation, as has been noted by regulators worldwide over the past few months. By the end of the portion of the public hearing dedicated to virtual currencies, the TAC voted unanimously to recommend that the CFTC create a subcommittee for this new asset class. Differentiating between different types of crypto-assets. One of the key points made by those who were invited to speak about the crypto-asset industry was that all of these tokens or coins should not necessarily be treated equally. For example, during his opening remarks, Coin Center Executive Director Jerry Brito discussed the differences between traditional cryptocurrencies, such as Bitcoin, and initial coin offerings, ICOs. cryptocurrencies like Bitcoin are commodities, of course, as the SEC has previously said. Questions remain, however, about the borders around these categories and about how one can responsibly share tokens to future investors, noted Brito. Special Counsel Gary DeWall of Catton Rosamond LLP went on to discuss the often mentioned Howey test and how it helps determine which types of tokens are securities under U.S. law. In DeWall's view, the CFTC could offer assistance in differentiating between commodities and securities in the cryptocurrency market. Ultimately, there has to be some clarification. The distinction between a commodity, the distinction between a security, may seem, from a common-sense perspective, clear, but there are very, very important issues around those that I think this committee could very much help clarify, said DeWall. Notably, DeWall also pointed out that cryptocurrencies are critical to decentralized ledgers. They are the mechanism in proof-of-work blockchains where miners are rewarded, in proof-of-stake blockchains where fees are paid. These are the ways you incentivize folks to keep the system together. If you're only talking about centralized ledgers, sure, you don't need to worry about coins, DeWall added. Regulation of cryptocurrency exchanges. RGM Advisors Chief Executive, Richard Gorlick, also made an appearance at the CFTC's public hearing, and he focused on the market structure of cryptocurrencies during his brief opening presentation, PDF. Gorlick was one of the only people in the room who referred to the subject at hand in terms of cryptocurrencies rather than cryptocurrencies or virtual currencies. One of the key areas of focus for Gorlick during his presentation was the problems associated with current cryptocurrency exchanges. More specifically, Gorlick discussed the issues associated with connectivity of liquidity between global exchanges. Generally speaking, I think trading on these exchanges can be challenging, particularly if your goal is to trade across multiple spot exchanges. It's difficult to weave liquidity across exchanges and jurisdictions due to a number of factors, noted Gorlick. Some of the factors limiting the movement of funds between various exchanges pointed out by Gorlick include technology concerns about deceptive trading, lack of standard best practices, the fickle nature of banking relationships, capital inefficiency, security and transparency, the slow speed at which money and assets can move in and out. In the face of these issues found on cryptocurrency exchanges, Gorlick hit on the large scale of the over-the-counter, OTC, markets. Representatives from LedgerX and CME also provided updates on the state of the Bitcoin futures market later in the public hearing. After gathering information from representatives of the cryptocurrency industry and asking questions, the TAC voted unanimously to recommend that the CFTC create a new subcommittee focused on virtual currencies. Ellen DeGeneres has presented a hilarious send-up of it on her highly popular talk show, taking Bitcoin and cryptocurrencies to a different level of mainstream exposure. The fact that Ellen stood in front of her audience and did a partial breakdown on how cryptocurrency works using the image of an adorable baby goat shows how far out of the shadows Bitcoin has come. Bitcoin has moved into mainstream media not long ago. Bitcoin was talked about in the same hushed tones as the dark web and was only mentioned in the media as the currency of cyber criminals. It was how international drug dealers and human traffickers funded their criminal empires. Today, though, references to Bitcoin have become commonplace in the news cycle and ad fodder for comedy shows. The general premise of which is that cryptocurrency is a little understood, nerd-based system of trading pseudo-money. Good for a laugh, but in the end just another fad that will surely pass along like Zumba or the pet rock. Though most of the send-ups of Bitcoin are about as tin can as the Ellen breakdown where she simply glosses over the system with a shoulder shrug and an eye roll to elicit laughs, there have been some genuinely hilarious skits that deal with the complexity of blockchain technology. Still a laughing matter, a fake commercial for Bitcoin that aired on the Seth Meyers show presented three women having coffee and playing cards when one goes into the most abstract breakdown of digital currency, blockchain and the crypto market you're likely to hear outside of a Reddit thread, while one friend pretends to understand every nuance and the other becomes incredulous about the gibberish. Likewise, the often subversive and consistently off-kilter Conan O'Brien aired a breakdown of Bitcoin by its founder Marcus Ortman, who rambles away using half-technical, half-new age lingo, even at one point parsing the famous flat circle speech from True Detective. Finally, Conan tries to corner him on giving a straight answer. At which point Ortman throws a smoke bomb and tries to disappear but can't even get that right. Bitcoin has moved out the murky depths of the dark web to the spotlight of mainstream media, even if it's only to be either derided or laughed at. Whether it be grumpy old billionaires calling it poisonous and asinine or comedians poking fun at the complex technology, the message is clear. Bitcoin is a thing for tech weirdos, like Dungeons and Dragons. That is until the next phase. I imagine the first blockbuster movie starring the muscle guy, I'm talking to you, Dwayne Johnson, and his sexy female sidekick tracking down the evil cybercriminal who made off with all the cryptocurrency raised to help the orphans isn't far off. A new poll of IT managers at large UK businesses found that exactly half keep stockpiles of cryptocurrency for various reasons. Unlike what some might imagine, only a very small fraction of the companies that are holding Bitcoin claim to be doing so as preparation for a ransomware attack. Also read, Coinbase develops BitPay competitor supporting BTC, BCH, ETH and LTC. Big British Bitcoin survey. Half of large British businesses hold stockpiles of cryptocurrency. A new research commissioned by software developer Citrix, Nasdaq, CTXS, has found that 50% of large British businesses have stockpiles of cryptocurrency. The study, which was carried out in partnership with OnePoll, surveyed 750 IT decision-makers within large UK businesses of 250 employees or more. It found that those businesses hold an average of 24 bitcoins each. Out of those companies, just 7% are investing in Bitcoin alone and 93% in a more diverse portfolio of cryptocurrencies. 54% have bought Litecoin, 43% Ethereum, 33% Ripple's XRP, and 29% Dash. The research also reveals that 57% of those holding Bitcoin sold off part of their stash around the December 2017 highs. The study shows that another 38% of these are considering making a sale these days. Just 5% have no current intention to sell their Bitcoins. As for the main reasons for holding such a portfolio, 40% say they plan to use the cryptocurrencies to pay providers, while 32% are aiming to pay their employees with them. Additional plans include using cryptocurrencies together with smart contracts or other blockchain technologies, 27%, as part of fundraising, 21%, and to pay for training, R&D or other demonstrative activities, 17%. Not just security fears. Half of large British businesses hold stockpiles of cryptocurrency. Unlike previous misconceptions, this survey reveals that just 4% of companies holding cryptocurrency claim to be stockpiling it as preparation for a ransomware attack. However, 64% say that its rising value has led cybercriminals to target their stockpile, and 31% believe a stockpile of cryptocurrency might make the business a target for hackers. Only 5% of responding companies in possession of cryptocurrency have not taken any steps to protect their reserves. Of those that have made changes to secure their assets, 52% have used specific backup procedures. Other popular security measures listed by the researchers include using cold storage, offline storage, 36%, moving to multiple wallets, 36%, using a dedicated hardened computer, 35%, and using dual control so multiple people are required to access the cryptocurrency, 22%. However, Citrix's Chris Mayers comments, "We know that very often, people are the weakest link in the security chain, and 18% of responding businesses say they worry that their hoard of digital currency might put them at risk of insider theft." Finally, according to the study, 35% are concerned cryptocurrency prices might crash, and 34% admit that fluctuating prices are discouraging them from stockpiling more. Another 18% are concerned that their business will not be able to cash the cryptocurrency in when required. What reasons do big companies have to HODL Bitcoin and other cryptocurrencies stockpiles? Tell us what you think in the comments section below. Just a short time ago, Cointelegraph was releasing last materials dedicated to the recent BlockShow Asia 2017. However, today the conference team came back to announce BlockShow Europe 2018, its third big conference dedicated to discovering the hottest innovations, trends and sensations currently happening in both European and global blockchain scenes. BlockShow Europe will be held from May 28 to 29 in Berlin. Why exactly so? According to the organizing team, Berlin was chosen as one of the main European centers for fintech and blockchain development. Apart from that, The large concentration of investments, startups, and innovative businesses makes the city an important hub for many trending industries. Last, but definitely not least, is the spirit of the city itself. Anna Sergius, head of product and operations at BlockShow, commented, "Berlin is the European capital of blockchain. Concentration of blockchain people is enormous. It's really easy to get along with the local community. Obviously, our next conference should happen here. For me, it's a very casual city. It's comfortable, convenient and full of freedom." With each new event, the BlockShow conference gets bigger. It is expected that BlockShow Europe 2018 will be visited by more than 3,000 attendees. Over 150 companies from all over the world will exhibit their projects, and 120+ organizations and companies will provide their support for the event. That's twice the size of the recent BlockShow Asia 2017, and about 5 times bigger than BlockShow Europe 2017. CEO BlockShow CEO Adi Krezi said, "The main mission which we are carrying through BlockShow, through each event of ours, to bring value to the blockchain community, to be helpful for any participant. We strive to yield benefits for startups, so they can get all the valuable connections they need among blockchain celebrities and investors, so they can establish partnerships they need. Blockchain projects can present themselves and raise funds. Those who want to make announcement to the world are absolutely welcome to make it from the stage of BlockShow. We're bringing value. This is our main objective and guidance. And this is exactly why our events keep growing, to be useful for as many people from the ecosystem as possible." What to expect? Throughout its existence, BlockShow seems to have worked out a perfect formula of what to offer to guests and participants. The upcoming event will be no exception. BlockShow Europe is going to reveal the most groundbreaking releases from various blockchain companies, the most successful blockchain-powered projects, as well as deep insights into how blockchain is being utilized in cutting-edge global industries, IoT, AI, cybersecurity, trade and finance, and others. Furthermore, the conference will be welcoming representatives of central banks and governmental structures who will share their experiences and plans for harnessing the possibilities blockchain can provide. Top blockchain experts around the globe claim 2018 to be the year of global blockchain regulations, so there is no way BlockShow won't raise this question at the main stage of the upcoming event. Our greatest aspiration is to reach balance and fairness for the global blockchain law, and this is our way to contribute to one of the main blockchain topics of 2018. BlockShow Europe 2018 is going to bring together over 80 internationally recognized influencers and experts from banks, institutions, and other global sectors. For 2 days straight, they will be delivering their professional experience, knowledge and more. Take a look at some of them. Luke Clausen, venture capitalist and executive director at Bitcoin Foundation. Milan Salaba, partner at Deloitte Consulting. Ahmed Said, lead, innovation office at SAP. Ivan Lilchukvist, speaker, blockchain influencer at Ivan on Tech. David Lee, professor, entrepreneur, director and advisor at Left Coast Drive. Julian Hosp, company founder and president at 10x. Jorn Leo Grand, executive VP, innovation labs at Wirecard AG. Ildar Fizulinov, CEO and founder at Well Incorporated. Eugene Etzebeth, business unit head, payments and ACH/central banks at Cybrin. There is so much more that BlockShow Europe is preparing for its guests. Each year the organizing team strives to bring more show to the whole concept of BlockShow, so there is no doubt this time the event will be packed with even more exhibition, expanded networking opportunities, and entertainment. Both of last year's startup competitions were a truly exciting and fun experience. In 2018, the event will keep this tradition of discovering and rewarding the most promising blockchain companies out there, so if you are a blockchain entrepreneur, this opportunity is for you. Don't miss out. Starting today, registration for BlockShow Europe 2018 is officially open. Learn more and register for the conference at the official BlockShow Europe website. Of course, there is no way we will let you get away without a special offer. So don't forget to use the code CTPOWER18 to save 30% off your purchase. See you in Berlin. At the start of the year, Italy's largest utility company Enel SpA was in talks with Swiss cryptocurrency mining startup Envian AG to sell power from wind, solar and other renewable energy sources to the miner, according to a report by Bloomberg. These talks were part of an effort by Enel to assess the growing market of selling electricity to cryptocurrency mining companies who require a large amount of power to run their operations. Due to the rising interest in cryptocurrency mining globally, and its required electricity consumption, utility companies are increasingly eyeing this sector to acquire new customers. Enel is particularly interested in understanding how the energy business can benefit from the blockchain technology, said Leonardo Zanella, head of Enel's Global Fund Trading Department, in January. However, this interest appears to have backfired on Envian as Enel ultimately decided not to provide it energy and said in a statement that it has no interest whatsoever in selling power for the purpose of cryptocurrency mining, according to a report published in early February by Reuters. Enel has undertaken a clear path toward decarbonization and sustainable development and sees the intensive use of energy dedicated to cryptocurrency mining as an unsustainable practice that does not fit with the business model it is pursuing, the company stated. Government-owned Enel is one of Europe's leading renewable energy-focused utility companies with a clear focus on clean energy production to offset the climate change crisis caused by non-renewable energy production. As cryptocurrency mining uses a substantial amount of energy to maintain blockchain networks that use the proof-of-work consensus mechanism, which requires substantial computing power, it should come as no surprise that the green energy-focused utility company has decided against pursuing cryptocurrency miners as a new customer base. Bitcoin mining and energy consumption. Debate rages. So what is the reality of crypto mining energy consumption? According to data estimates by DeGeneres, the Bitcoin network's current estimated annual electricity consumption per annum stands at 47.4 TWh, roughly equivalent to the annual energy consumption of Singapore. This, in turn, equals to 0.21% of the world's total energy consumption, which means that the Bitcoin network consumes more energy than 159 countries. However, not everyone agrees with DeGeneres' estimates. According to CNBC, Stanford University lecturer Jonathan Koomey said, "I would not bet anything on the Bitcoin thing driving total electricity demand. It is a tiny, tiny part of all data center electricity use." Koomey also highlighted that there are many assumptions that go into DeGeneres' model and claims it is fundamentally flawed as it uses estimates of miners' revenues and expenses as opposed to hard data. Anytime you do that, you introduce multiple layers of error and uncertainty. It's a completely unreliable way to do the analysis, and no credible energy analyst would ever do that, he told CNBC. Christian Catalini, an assistant professor at the MIT Sloan School of Management who studies cryptocurrencies, shares Koomey's view and said, "Many of those calculations that you see today I think are based on very weak assumptions. I don't think anybody can make a credible claim about the current electric power use for Bitcoin mining without actually having data from the miners." Regardless of the accuracy of certain Bitcoin network energy consumption predictions, the reality is that Bitcoin mining in its current state is not environmentally friendly and that needs to change. If not, Bitcoin miners could face more pushbacks from environmental agencies, NGOs and governments with a green agenda. Cryptocurrency mining is not just Bitcoin. A further aspect that needs to be discussed when talking about the energy consumption of cryptocurrency mining is that Bitcoin now only makes up around 35% of the entire cryptocurrency market. However, the majority of the almost 1,500 digital currencies available today use the power-intense proof-of-work mechanism to secure their networks. This means that the energy consumption from cryptocurrency mining globally is substantially higher than those discussed by experts for the Bitcoin network. Of the top 15 cryptocurrencies, almost half utilize the proof-of-work consensus algorithm to process and verify transactions, including Ethereum, Bitcoin Cash, Litecoin, Monero, and Ethereum Classic. And, as the combined market capitalization of these altcoins exceeds that of Bitcoin, the energy consumption of these blockchain networks need to be taken into consideration when assesses the global impact of cryptocurrency mining. Green energy mining and alternative consensus mechanisms. It is not a surprise that many cryptocurrency miners, such as Envian, are now looking to utilize green energy to power their operations so that blockchain networks can be supported without contributing to environmental damage. through the use of renewable energy sources wind, solar or hydropower, Bitcoin mining can become more eco-friendly. A more environmentally friendly option altogether, however, are cryptocurrencies that use alternative consensus mechanisms to proof of work that do not require high energy consumption to process transactions, such as proof of stake. Whereas proof of work requires miners to use substantial computing power to verify and process transactions for which they are then rewarded in new coins, the proof of stake consensus mechanism uses network participants' stake coins to run the consensus. Hence, it does not require any cryptocurrency mining hardware. Instead, the members of the network who stake the most coins will receive the most new coins for their contribution to secure the network. In 2014, the digital currency NXT was the first coin to purely use proof of stake. Since then several others have followed, including Litecoin, Allcash, and the popular privacy-centric coin PIVX. Moreover, Ethereum developers are working on switching the Ethereum network from proof of stake to proof of work. Given the unsustainability of cryptocurrency mining, it is likely that many future cryptocurrency networks will opt for a more environmentally friendly consensus mechanism such as proof of stake, while Bitcoin miners will likely increasingly opt for green energy solutions. A decentralized exchange, DEX, is a marketplace for cryptocurrencies or blockchain investments that is totally open-sourced. Who controls trading process then? Well, it's completely automated, and trades are conducted and controlled by users themselves. How does it work? Basically, proxy tokens, which are crypto assets that represent a certain fiat or cryptocurrency, are created through a decentralized multi-signature escrow system. Decentralized exchange servers are distributed, which means their servers are spread out so that there is no risk of a server downtime. Unlike the traditional centralized system, the system uses an automatic peer-to-peer payment network with no central authority. The money is held by the owner only and safely stored in a wallet, protected by a unique key, which makes it essentially a trustless system. If the money is held by the owner, there's no need to trust a third party. To add to this, disclosing of personal information is not required, as it usually happens with a centralized transaction. Anonymity is the DEX's key and its milestone. Decentralized system is also different from the centralized model in which users deposit their funds. When a user is about to withdraw the funds, these are converted back into the cryptocurrency they represent and sent to the owner. In a decentralized exchange, you can create an account and start trading right away. If DEX are so brilliant, why don't they rule the market yet? Till now, there were a few drawbacks of a current DEX system that made the rise quite challenging. The lack of liquidity compared to the more popular centralized exchanges. Unfortunately, there is no user support and poor UI which won't attract a mainstream user base. Some decentralized exchanges require users to be online in order to be listed by them and for a trade to take place, requiring users to perform certain actions like signaling that a payment was received. Trading features like margin trading, lending and stop loss are currently not available in the decentralized model, as they only allow the basic exchange of currency for a predetermined value. Sometimes a transaction is declined by the network. All of these issues are seriously taken into account. As the whole blockchain industry develops rapidly and the demand increases day by day, experts are working hard over various solutions. Good news, however, is that there are solid DEX platforms out there. Here's a list of DEXs you should consider start using right now. Bancor Protocol. Bancor created a unique token relay technology, which is basically a simple and ready-to-use online converter. Its aim is to address the liquidity challenge. If the ways in which consumers make transactions using cryptocurrencies could be unified and simplified, then it's not difficult to imagine that the demand for such assets would increase even more. As of now, about 30 coins are available for converting and trading within the Bancor network, a token box, TBX, token included. Waves DEX. It's a decentralized exchange, which is based on the Waves blockchain technology. It allows users to trade their tokens, including Waves, BTC and other assets issued on the Waves platform, completely trustlessly and without having to move the funds to a centralized exchange. OpenLedger DEX. OpenLedger is a blockchain-based company with a headquarters in Denmark. It provides decentralized solutions for the crypto market. OpenLedger DEX leverages BitShare's graphene technology to cater its services. CryptoBridge DEX CryptoBridge is a new entry in the decentralized crypto exchange markets. CryptoBridge is a decentralized exchange running on top of the BitShares network. It supports decentralized trading of all popular altcoin pairs without a single point of failure. Only a user holds private keys to the funds and has access to them. BISQ, also known as BitSquare. BitSquare is a peer-to-peer marketplace for crypto assets. It is a fully decentralized exchange which requires no name, email ID or verification. To be a truly anonymous peer-to-peer network, it uses Tor and doesn't hold fiat or bitcoins on their servers or on their account. Every aspect of this exchange is decentralized from placing an order to matching and executing it. Why DEX could be the future? Surprisingly, all the projects listed above have entered the cryptocurrencies industry during the last 9-7 months. The market obviously has serious sentiments towards cryptocurrencies and other decentralized assets. Also, the latest international regulation attempts, especially China's ban strategy and cautious South Korean policy, catalyze the need of developing DEXs more than ever. Keeping in mind all the current downsides, they are the only way that cryptocurrencies can survive and thrive. The kind of benefits that DEXs provide, gives the owner of the funds control, is anonymous, protects users against hacks and has no server downtime, will ultimately dwarf the shortcomings. Author Vladimir Smirkis is the co-founder and managing partner of TokenBox, unique ecosystem that combines cryptocurrency funds under the control of professional portfolio managers and traders on the one hand, and investors on the other. Malware that surreptitiously mines cryptocurrency while you browse the web is big news right now, literally in the case of news outlet Salon, which has enabled it as an opt-in feature. One thing that it certainly isn't, though, is big business. Every other day, media outlets seem to be running stories about the latest crypto-jacking scams. While these tales are mostly true, the extent of the problem has been vastly overstated. Smart criminals aren't covertly crypto mining in browser, not because they're incapable of doing so, but because even at scale it simply isn't profitable. Also read, nuclear engineers arrested for mining cryptocurrency using government supercomputer cryptojacking malware. Browser mining crypto is a complete waste of time. Last weekend, it emerged that the Browse Allowed web browser plugin had been hijacked, causing it to covertly mine cryptocurrency on around 5,000 computers. Among those affected were systems used by a number of British government bodies including the National Health Service and a student loans company. At the time, a spokesperson for the UK's National Cybersecurity Centre said, NCSC technical experts are examining data involving incidents of malware being used to illegally mine cryptocurrency. Government websites will continue to operate securely. At this stage there is nothing to suggest that members of the public are at risk. Naturally, members of the public weren't at risk, in any sense of the word. The only real side effects of having your browsing session cryptojacked are perhaps a slowdown in computing performance and the device heating up. The majority of web users wouldn't even be aware that anything was amiss. While relatively benign, as cyber attacks go, mining malware is still an inconvenience that no web user would reasonably be expected to tolerate except for instances where that was the price of access. Salon sparked headlines this week after unveiling plans to do just that as a means of monetizing its news site. Browser mining crypto is a complete waste of time. Mining for kernels of truth. Media organizations are constantly seeking new ways of monetizing their sites. In an era of ad blockers and diminishing attention spans, generating any sort of payment per click is an achievement. The notion of web users mining Monero, an anonymous cryptocurrency synonymous with the deep web and its wares, in order to fund a mainstream news site is an amusing one. It's also an illogical one, on many levels. According to estimates provided by CoinHive, the software used by Salon as well as by the criminals in last weekend's UK-wide cyberjacking scam, the return to be made on browser mining is pitiful. Browser mining crypto is a complete waste of time. 1 million visitors spending 5 minutes on a website would result in a total of $64 of Monero being mined. The 5,000 UK government machines that were infected using CoinHive netted a paltry $24 in Monero. Browser mining cryptocurrency, be it on a permissioned or permissionless basis, is unprofitable. If you're going to bend the rules to mine crypto, you need access to a government supercomputer and the skills to avoid getting caught. Otherwise, the juice simply isn't worth the squeeze. Would you consent to having your computer mine cryptocurrency instead of being served adverts? Let us know in the comments section below. Featured 6 hours ago. See Edward Calso 947266 Berkshire Hathaway, Bitcoin is disgusting, detestable, noxious poison. Daily Journal's annual shareholder meeting usually involves Berkshire Hathaway's vice chairman, Charlie Munger, giving his overview of things economic. This Valentine's Day, the 94-year-old right-hand man of Warren Buffett took the opportunity to savage the world's most popular cryptocurrency, Bitcoin. Berkshire Hathaway wants cops unleashed on Bitcoin. If it's not a religious affair, it sure has that feel. The Grand Cardinal of retail finance, Charlie Munger, was plopped into a chair and assembled hordes gathered to hear investment wisdom from the Oracle of Omaha's saintly priest. To say Mr. Munger is a successful investor is to place too general praise on the man. Arguably he is among the most bankable gurus of all time. From Los Angeles, Mr. Munger came right out with it. I never considered for 1 second having anything to do with Bitcoin. I detested it the minute it had been raised. The more popular it got, the more I hated it. It's just disgusting that people have been taken in by this. Berkshire Hathaway, Bitcoin is disgusting, detestable, noxious poison. The focus of his remarks was not Bitcoin per se, as the question and answer period, interview style, lasted over 2 hours. He discussed a myriad of economy-related questions and subjects, including regulating banks such as Wells Fargo, Berkshire Hathaway's large stock holding of nearly $30 billion. There, Mr. Munger came to the embattled bank's defense, suggesting government regulators had gone far enough in efforts to get it to right past wrongs. Indeed, Mr. Munger suggested regulators had done too much. Wells Fargo was accused of creating fake accounts to buttress numbers, adding automobile insurance charges to customers who didn't ask, and monkeying with mortgage extensions. Tension between old and new when it came to Bitcoin, however, our more relaxed approach is wrong, he spat. The right answer is to step on it hard. It's the government's job, he urged, characterizing it as a noxious poison. He seemed to approve of alternative payment systems such as WeChat, the popular smartphone application based in China. But Bitcoin, he said, was an affliction of everyone wanting easy money, and hope to God the future generation doesn't embrace it, as it is totally asinine. Berkshire Hathaway, Bitcoin is disgusting, detestable, noxious poison. Charlie Munger. Berkshire Hathaway's stock price trades routinely at over $300,000, and that's not a misprint. The firm is notoriously tech-phobic, having sat out plenty of the technology boom over the last quarter-century. Mr. Munger has been involved with the company for over 4 decades, championing value investing, looking long-term at good companies an investor can understand. For seasoned investors such as Mr. Munger, Bitcoin is too abstract. Its lack of fundamentals as Mr. Munger understands them, no corporate offices, no accountable board, no large regulatory apparatus, etc. can only spell Bitcoin's doom. It's a classic division among investors these days, between those who were stuck in old world success enough to fail in appreciation of what just might be a real changing of the financial guard. What do you think of Mr. Munger's comments? Let us know in the comments section below.